Today, I want to talk about a simple but powerful concept in real estate investing called the capitalization rate, the cap rate. It's a basic and fundamental starting tool for evaluating properties. My aim is to explain what it is, who and when to use it, why it matters, and how to calculate it. Hi friends, thanks for being here. I'm Mandy, a licensed appraiser, scrivener, and broker here in Taiwan. I work with commercial and industrial properties, doing everything from valuations to title transfers and brokerage. Legal and financial stuff, yup, that's part of the job too. This channel is for sharing tips and know-how about real estate investment. If you are into real estate or just curious, there's a subscribe button so you don't miss out on any videos where I share tips, know-how, and real talk about the property investment. What is the cap rate? The cap rate is a quick way to estimate the return on real estate investment based on the cash a property produces. It's expressed as a percentage and calculated by dividing net operating income by its market value or purchase price. Net operating income is a property annual gross income minus operating expenses before mortgage payments and income taxes. By the way, property value can be easily calculated by dividing net operating income by the cap rate. That is what we call income approach, one of three main valuation methods. Appraisers usually use it to do their jobs. Who use it? Investors, brokers, appraisers, lenders, or analysts all use it. For the beginners, think of it as the first filter. Investors use it to compare different markets and properties. Brokers use it to price deals. Lenders look at it to gauge risk. Even property managers or owners refer to it to see how a property performs relative to others. So, you usually hear people bring up cap rate when they are selling, buying, or just trying to figure out which income property is worth to buy, such as multi-family units or office. It's very useful at the very beginning, when you are checking out the deals or just trying to get a quick idea which property could be worth based on the cash it brings in. Cap rates comes up when you are looking at the similar types of properties in same neighborhood or city. Compare a 6% cap rate for downtown office to a 10% cap rate for rural warehouse is meaningful without any contests. So, in some professional settings, some certain key points are commonly included. However, since this video is for beginners, we don't talk about those topics in details. Why is it matter? We can use the cap rate for four purposes. Number one, quick comparison. It lets us to compare apples to apples across properties and markets without getting into that details. Number two, we can use the cap rate for value estimation. When you got the market cap rate, it's easy for you to value the property. Number three, we can use the cap rate for risk signal. In general, higher cap rate imply higher perceived risk and lower demand, such as less desirable location, old building, or unstable tenants. Low cap rate suggests lower risk and higher demand, such as prime location and stable income. Number 4, we can use the cap rate for decision making. It helps us decide whether a property is overpriced or bargained based on expected cash flow. Let me walk you through how to do it step by step. First, start with the annual gross income. It's simply total income you collect in 1 year, assuming a property is fully occupied. Don't forget to include the other income. These could include things like deposit interests, laundry income, parking fees, or other service charges. Next, you need to account for vacancy and credit loss. In reality, units aren't always rented, and sometimes tenants don't pay. It's very common to deduct about 5% to 10% of total income depending on the market. Then, to subtract operating expenses. These include costs like insurance, maintenance, property management fees, utilities, property taxes, and repair reserves. One important point here, don't include mortgage payments, income taxes, and other major capital expenditures when calculating net operating income. When you have done all that, you will arrive at your net operating income, NOI. Finally, to divide that by the market value or purchase price, that gives you the cap rate. That's it. Simple in structure, but very powerful for evaluating income properties. Let me give you an example. Imagine you buy an office for $7.5 million US and then rent it for $35,000 per month. The annual gross income is $420,000. Assuming there is no much the other income, so let's keep it simple and not add the extra income. Next, assuming a vacancy rate of 5%, that reduces you with $21,000, leaving you with $399,000. Now, let's subtract operating expenses. For example, property management fees, $36,000. Property taxes, $20,000. Maintenance and minor repairs, $15,000. And insurance, $5,000. So, the total expenses is $76,000, leaving you with a net operating income with $323,000. Finally, you divide that by your purchase price, $7.5 million. You get the cap rate of about 4.3%. So here is a question. How do we know whether something like 2% or 4% or 6% is good? Remember what we discussed in when to use the cap rate. The cap rate comes up when you are looking at the similar types of property in same location or neighborhood. Cap rates are based on actual transaction data for specific location and property types. So the key is to look up the cap rate range for a market and use that for your reference point. Cap rate is a simple, powerful starting tool for evaluating income properties. It tells you the expected unlevered return and gives you a quick signal, but it's not a complete measure. For smart investing, verify income, understand the expenses and the market context, and combine cap rate analysis with deeper due diligence and financial consideration. I hope this video gives you a clear, practical foundation for using cap rate. Don't forget to subscribe to the channel and give this video a like. I'm happy seeing you in the next video.